Chairman Hall, we're ready to begin when you are.
Thank you, Ashley. Good morning. This meeting of the board is a hybrid physical virtual meeting. I would like to welcome those in the boardroom with me today. While keeping your microphone muted, please join me in the Pledge of Allegiance.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
At this time, I will ask the Secretary to the board to address a few technical and protocol items.
We have a quorum. The full board is present for this meeting, Chairman Hall and Board Member Smith. Please ensure that you have silenced any mobile devices you have with you. The virtual portion of this hybrid meeting is on Cisco WebEx. We have two OIT staff, Ben Rana and Victor Amaya, monitoring and managing the meeting. They will be locking this meeting and no new connections will be allowed. OIT will be advancing the slides, so you will hear presenters say, "Next slide." If you lose connectivity in this meeting, please contact Victor Amaya. Lastly, this meeting is being recorded. The video recording of the open portion of this meeting will be posted for public viewing for a limited period of time. Chairman Hall, that concludes the technical and protocol items. We're ready to continue when you are.
The Secretary will now read an opening statement on the government in the Sunshine Act.
This is an open Farm Credit Administration board meeting under the Government in the Sunshine Act. If anyone raises a subject that may be discussed in closed session as permitted by the Government in the Sunshine Act, Chairman Hall will entertain a motion to close the meeting.
We'll now review the published meeting agenda. Is there a motion to adopt the agenda as published?
There is. I move to adopt the agenda as published.
I second the motion. The motion has been made and seconded. Is there any further discussion? If not, the Secretary will record the vote on the motion.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carries. Next, we will consider whether any portions of the meeting should be closed to the public.
Mr. Chairman, the agenda does not include items that we should properly discuss in closed session. I move that the entire meeting remain open.
Second the motion. The motion has been made and seconded. Is there any further discussion? If not, the Secretary will record the vote on this motion.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carries. If you will, please turn to tab 1. The next item on the agenda is approval of the minutes as presented behind tab 1.
I move to approve the minutes for the November 13th, 2025 regular board meeting as presented.
And I second the motion. The motion has been made and seconded. Any further discussion? If not, the Secretary will record the vote on the motion.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carried. Next item is a quarterly report on economic conditions and Farm Credit System condition and performance. At this time, I will ask Skylar Ochiltree, Nicole Yadoff to present a quarterly report on economic conditions. This will be an information item. Skylar?
Chairman Hall, Board Member Smith, good morning and thank you for having me back. I'm Skylar Ochiltree with the Office of Data Analytics and Economics, and I'm joined today by my colleague Nicole Yadoff with the Office of Examination. Next slide, please. Today I will provide a quarterly economic update, and Nicole will follow me with an update on the condition and performance of the Farm Credit System. Next slide, please. Beginning with our macroeconomic dashboard I covered at the beginning of the year, we see key metrics moving essentially sideways since then. Despite a turbulent year, the economy should be closing 2025 on a relatively favorable note, barring any surprises from delayed data. Real GDP growth had stabilized around 2.5 to 3% this summer, but we won't get the latest data here until the end of the month. Interest rates have moderated with 25 basis point cuts by the Fed in October and September, as well as another 25 basis point cut yesterday. The unemployment rate, last recorded at 4.4% in September, is the highest since 2021, but remains historically low. Delays in data gathering for this measure have created further uncertainty for the market, policymakers, and observers to deal with during the government shutdown. PCE inflation is 2.8% as of September, and while trending downward, remains above the 2% target. Labor market dynamics remain a concern and have become the more closely watched aspect of the economy over the last several months. Next slide, please. This scatter plot compares actual inflation and employment to the Fed's 2% and 4% benchmarks. The green X's are historical data going back to 1960, with the last 5 years mapped in blue. As you can see, we've had a bit of a wild ride through the pandemic. First with unemployment spiking, then inflation, but we largely avoided any periods of true stagflation, which historically spikes loan delinquencies. Both variables hover near their targets at this point. The Fed is in a challenging position because the risks to both sides of the mandate, employment and inflation, are elevated. With delays in data, this makes their job even harder. October Fed minutes signaled a data-dependent stance. They will hold rates steady while watching wage price dynamics. Wage growth is still running at 3.2% year over year, and labor force participation remains below pre-pandemic levels, creating a subtle pressure on farm labor costs. The Fed's latest action is intentionally cautious and non-committal, a measured adjustment that preserves flexibility amid mixed signals on inflation and employment. We also note a divide between officials focused on inflation and those more concerned with labor market softness. Next slide. Moving on to fiscal and trade dynamics, in this chart we observe a trend of corporate profits against tariff receipts. The corporate profit data are non-financial firms to better isolate companies which would be more exposed to tariffs. Our chart shows that non-financial corporate profits have slipped 7.4% year over year, while tariff receipts jumped 176% in Q1 of the year. The widening gap suggests firms are absorbing a portion of the tariff burden, which has helped keep consumer inflation modest. Though the data is a little stale, we're also watching import prices of goods, which have not yet shown a decline. If this starts to decrease, it may suggest importers are lowering prices to offset tariffs, but yet again, this is not the case so far. As you can see, corporate profits have been very good over the last several years, affording some room to absorb increasing prices. Next slide, please. Input prices remain elevated across both ag and non-ag sectors. Here we show input price trends divided into two categories, manufacturing and services. These are broken out because the manufacturing side is assumed to have greater reliance on imported cost of goods sold. This data shows persistent cost inflation, especially in services. And although manufacturing shows a slowing of cost increases, any reading in this chart above the 50 line still indicates an increase. This further supports the notion that firms are facing increased costs to some degree and need to either absorb them or pass them through. With cooling demand and weakening manufacturing conditions, firms may be pushing off purchases of raw materials, reducing pressure on cost inflation. Through September, manufacturing jobs posted 5 consecutive monthly declines. With so many opposing forces at play, the level of uncertainty remains elevated. Next slide, please. Consumer confidence fell to 88.7 in November, down from 112.8 a year earlier, reflecting both price and tariff concerns. Yet a separate survey shows 60% of manufacturing firms have increased selling prices in the last quarter. Meanwhile, profit margins in the manufacturing sector have contracted 10% year over year as of Q2. The combined evidence points to mixed pass-throughs. With tariffs being a factor in driving down consumer confidence, I wonder if we will see more pass-throughs to consumers if consumer confidence were to shift to a positive reading. Next slide, please. To summarize conditions in the ag sector, bumper crops are creating marketing challenges amid a fluid trade environment, storage shortages, and widening basis. Record beef prices are driving profitability and risk-taking. Dairy herd expansion is underway, but producers are managing risks through culling at high prices. Hog margins have turned positive again after a volatile 2024. Export outlook is mixed. The new deal with China could mean price stability for soybeans, but volatility remains in some of our key export commodities due to shifting global trade dynamics. Continued stress in grains, tree nuts, and grapes are areas to continue to watch closely, and ad hoc assistance continues to play a key role in supporting producers. Next slide. Soybean prices have rebounded due to a new trade deal with China, but U.S. exports are still under pressure from competition. There's also quite a bit of uncertainty around how the commitment from China will actually play out. China has so far purchased an estimated 3 million metric tons of the 12 million metric tons that they committed to buy. And recent comments from Treasury Secretary Bessent indicate that China's 12 million metric ton purchase of U.S. beans would be completed by the end of February rather than year end. Corn ending stocks are down slightly from the prior month, and the season average price is forecast at $4 a bushel. Export inspection data showed robust foreign demand during November and implies total shipments during the September-November quarter will likely exceed 800 million bushels. And this surpasses the prior high set during 2007. We've seen some strong weeks for U.S. ethanol production. The last report was at 1.126 million barrels per day, above trade expectations and almost 5% above production last year during the same week. Next slide, please. Margin compression continues as fertilizer price increases squeeze operating margins in the grain sector. In this chart, we see index trend of select major crop inputs since 2010. Returns to major row crops in the U.S. have been poor since 2023, with low to negative average returns projected to continue for 2025 and into 2026. The CCC did get its full year's funding with the continuing resolution bill that passed to end the shutdown. ARC, PLC, and potentially any MFP payments should be available quickly next year. The new package announced this week should provide row crop producers with some relief, although some estimates have this aid package only covering 30% of estimated farm losses. Next slide, please. Focusing in on two of our riskiest crops at the moment, given their dependence on export markets, we see almond exports continuing to expand and the unit price improving as the industry finds new growth in primarily European markets. Still, this remains an area to watch closely given profitability struggles for a prolonged period. I will also note that we've seen adjacent specialty crops like pistachios experience a significant drop in exports, especially to China. It appears the almond producers have been more successful at growing alternative markets. Hopefully, pistachios will soon follow suit. The soybean picture demonstrates the struggle with this crop as a result of China's apprehension to buy U.S. beans. But this trend could revert to historical averages if China follows through with its recent commitments. China's purchasing power has the ability to quickly remedy these and other export-dependent goods, so we'll continue to monitor the trade situation closely. Next slide, please. While record beef prices continue to steal headlines, we have two charts here to show the changing risk in dairy and hogs. Notice the rising trend in dairy herd this year. Dairy producers are expanding given recent profitability and taking expansion risk when they have easy access to high-priced coal markets because of high beef prices. On the hog side, we see a strong turn to profitability after several below break-even years. We're watching this portfolio closely to see when credit quality may turn because of the improved market conditions. Next slide, please. If I can share some closing thoughts, the economic environment remains complex with inflation moderating, but the labor market fragility emerging. Ag producers faced a mixed outlet. Strong yields and weak prices mixed with persistent cost pressures and export uncertainty. While profitability in grain is currently low, the liquidity and solvency positions of most grain farms remain strong at the end of 2024. However, continued low profitability resulting in deteriorating liquidity and solvency is the primary risk. With renewal season quickly approaching, we will get some new insights into current conditions and hopefully the current data gaps will quickly close. Thank you for your time today, and I'm happy to take any questions before handing it over to Nicole.
Thanks, Skylar. Questions from?
Yes, Skylar, one question. We're focused on exports and in a lot of cases, not real good news there, especially on soybeans, almonds, some of those crops. I personally, I see some hope in developing our domestic demand. E15 is been talked about a lot here of recent, soy diesel of recent. Any new news on that front that would offer some hope for those value-added products that are consumed right here in the United States?
Yeah, it's a great point. And I think part of the benefit of this ongoing situation with China is just forcing innovation and innovation not, and we're seeing it with almonds with the European markets. All of a sudden, a lot of European countries are starting to take our almonds. And then domestically, if we can, that the driver for that innovation and maybe getting to E15 would be another innovative measure to help help the demand side of this equation.
Yeah, I always have commented for years now, if we were to lose that ethanol demand in any shape or form, the repercussions would be huge in farm country. So it's hopeful anyway at this point. Thank you, Scott. Thank you, Mr. Chairman.
What about sustainable aviation fuel? I mean, we've heard about this for several years now. Are there any developments there to improve demand in that area or utilization?
Yeah, I wish I could speak to that confidently, but I'm really not in the know on that. But I can certainly look into that and get back to you.
If you would, thanks.
Yeah.
Thank you, Skylar.
Good morning, Chairman Hall and Board Member Smith. My part of today's presentation is to provide an update on the financial condition and performance of the Farm Credit System as of September 30, 2025. Overall, the system reported sound financial results for the third quarter of 2025. System capital showed consistent growth. The system loans portfolio continued to perform well overall, although credit risk measures did trend higher. Quarterly provision for loan losses has consistently increased since June 2024. Overall, loan growth year-to-date has slowed. Finally, composite FERS ratings continue to be good, materially unchanged from the previous quarter. Next slide, please. Focusing now on system growth, as of September 30, system assets totaled just over $561 billion, up 0.8% for the quarter and 3.1% year-to-date. System loans totaled just over $437 billion. The chart on the left shows year-to-date portfolio growth going back to 2016. For 2025, economic and seasonal factors were the primary influence of loan growth for the quarter, and overall year-to-date growth has slowed slightly. The chart on the right illustrates system loan growth in the major loan categories for the past 3 years. Collectively, these loan categories represent just over 96% of the system portfolio. Production and intermediate loans have remained relatively unchanged. For agribusiness, a significant portion of the slowed growth continues to be in loans to cooperatives due to lower levels of seasonal financing driven by lower cash grain prices. Next slide, please. The next couple of slides focus on system loan quality. While the portfolio of credit quality remains sound, credit risk measures continue to trend higher in the third quarter. As of September 2025, non-performing assets totaled $4.3 billion, up from $3.2 billion at September 2024. Non-performing assets as a percentage of loans outstanding and other property owned increased to 1% from 0.79% a year ago. Non-accruals, which account for just over 91% of non-performing assets, increased to $4 billion. Credit deterioration impacting certain borrowers in limited stress sectors included tree nuts, wine and distilled beverages, and various food processing sectors. The chart on the right shows non-accruals as a percentage of loans outstanding. Non-accruals increased significantly for both production and intermediate loans, and to a lesser extent, real estate loans. Persistent low to negative margins in several crop sectors has reduced producer cash flow. Macroeconomic factors, including strong global production, a strong dollar, and tariff and trade uncertainties with key trading partners, has also negatively impacted grain and farm supply cooperatives. For segments of non-performing assets that are accruing loans 90 days or more past due, a portion of these loans and loans for crop producers are concentrated in USDA guaranteed loans. Next slide, please. The chart on this slide shows a percentage of loans within the portfolio classified less than acceptable by major loan category. As the chart indicates, the percentage of less than acceptable loans increased for all loan categories except for rural infrastructure. At a portfolio level, less than acceptable loans as a percentage of loans outstanding equaled 6%. This is up from 5% at September 2024. Both production and intermediate loans and agribusiness loans had the highest level of less than acceptable loans, with volume increase to 8.9% and 8.4% loans outstanding respectively. Next slide, please. Overall, the system reported sound financial results for the third quarter 2025. Year-to-date system earnings increased 1% to $5.97 billion as compared with the same period a year ago. The line at the bottom of the chart shows the trend in the level of provision for credit losses. As you can see, credit provisions increased from $350 million a year ago to $868 million. This increase is associated with credit quality deterioration for a limited number of borrowers and higher modeled credit losses. The chart on the right highlights the changes in key components of net income year over year. The most significant year-over-year changes continued to be net interest income and loan provisions. Although net interest income was up $544 million compared to a year ago, the $518 million increase in provision for credit losses almost completely offset that increase in net income. Next slide, please. The chart at the top focuses on net interest spread and net interest margin. Net interest spread declined 2 basis points to 1.84. This was largely related to loan spread compression due to competitive market pressures. Net interest margin declined 5 basis points to 2.36% as compared to year-end 2024, and reflected both the decline in net interest spread and lower income earned on assets funded by non-interest sources, primarily capital. Although net interest margin is down compared to last year, as the previous slide showed, net interest income increased $544 million year-to-date, driven by growth in the level of average earning assets. The chart on the bottom highlights year-over-year changes in average earning assets. As the chart indicates, average earning assets for the 9 months ending September 30 grew 8.3% or $41.1 billion to $535 billion. Next slide, please. The next slide focuses on system capital. The system continued to maintain sound capital levels with steady earnings continuing to support capital growth. As of September 30, system capital totaled $84.3 billion, up from $5.5 billion or 7.2% year over year. The system capital to assets ratio remained unchanged at 15% for the third quarter. As noted on the slide, regulatory capital levels at all system banks and associations remain sound and continue to be well above regulatory requirements. Capital and the allowance for loan credit losses equaled 19.8% of loans outstanding. 73% of system institutions had a 1 rating for capital, and all institutions were in the 1 or 2 range. Next slide, please. For an individual institution, composite FIRS ratings represent an overall assessment of the safety and soundness of that institution. The chart on this slide provides a snapshot of the combined composite FIRS ratings for all Farm Credit System banks and associations. Overall, composite FIRS ratings for the second quarter continued to reflect the system's strong financial position. Collectively, over 96% of banks and associations currently have a composite rating of 1 or 2. 2 institutions had a composite rating of 3 or worse, unchanged from year-end 2024. In total, about 4% of system assets are held by institutions rated 3 or worse. Next slide, please. Agricultural producers and system institutions have faced a difficult operating environment in 2025. Changing economic conditions and an uncertain growth outlook for both the U.S. and world economies presented substantial challenges for agriculture. Agribusiness profit margins have declined due to higher input costs and unstable demand. Grain producers continue to face considerable margin compression as large production levels, elevated production costs, and export uncertainties have pushed prices lower. Declining net farm income and an elevated interest rate environment have important implications for farmland and collateral valuations. As we have already seen, this more challenging environment for borrowers is likely to be reflected in system credit quality. That said, the system is financially sound and has considerable risk-bearing capacity. Farm credit institutions are well positioned to meet borrower funding and liquidity needs. This concludes my part of today's presentation. Chairman Hall and Board Member Smith, I would like to thank you for your time and attention today. And at this time, I'd be happy to answer any questions that you have.
Board Member Smith.
No questions. Thank you, Nicole.
Thank you.
Nicole, I want to go back to something you mentioned on provisions for credit loss. Did you say those were isolated to a few large loans that increase?
Correct.
I see a lot of theme that Hal Johnson has provided over the years that keeps coming through in our presentations in this Hal's last board meeting. I just want to say thanks, Hal. You've done a great job, and you can see a lot of your work come through on our new presentation. So thank you, Hal. If there are no further questions from the board, thank you for your presentation, both of you. And now we'll turn on to tab 3, and I'm going to ask Jessica Campbell and Nicole Peak to present the semi-annual report on OE operations. This will be an information item.
Good morning, Chairman Hall and Board Member Smith. I'm Jessica Campbell, a senior examiner in the Office of Examination out of our Bloomington office, and I am here with my colleague Nicole Peak, a senior examiner for the Office of Examination. We're here today to present the semi-annual report of operations for the Office of Examination for fiscal year 2025. Next slide, please. Much of today's presentation will focus on the results of activities related to OE's operating plan objectives, including risk supervision and examination of system institutions, including a review and an update on the status of our fiscal year 2025 National Oversight Plan, focus areas, and related activities. In addition, we will discuss the system's fulfillment of its public mission, OE's operational efficiency and effectiveness, and human capital planning. We will also provide an update on OE's budget results for fiscal year 2025. Next slide, please. This slide highlights what was accomplished during fiscal year 2025 for our risk supervision and examination objectives. For example, OE conducted on-site examination and oversight activities as planned at all 4 funding banks, 50 associations, as well as 6 other entities. OE issued 48 reports of examination, slightly up from 46 reports of examination issued the prior fiscal year. We issued 32 interim activity letters compared to 43 interim activity letters the prior fiscal year. The capital market HEA in fiscal year 2024 was the primary reason for the increased activity letters last year. We issued 66 financial institution rating system letters compared to 72 last fiscal year. Also, while most system institutions operated under normal supervision, there was one institution under elevated level of supervisory oversight at the end of the fiscal year, and another has been added since. The primary concerns were related to the governance areas. In addition to oversight and examination activities, other examination-related efforts included issuing examination guidance both internally to staff and externally to system institutions. For example, since our last report to the board, we issued an informational memorandum communicating the National Oversight Plan for fiscal year 2026. Combined, we made 5 updates or revisions to the examination manual, the examination work papers, and OE directives. For the examination manual, in the last 6 months of the fiscal year, we made the following updates. In September 2025, we published internally and externally updates to the following exam manual guidance: structure and use of the exam manual, overview of the examination process, supervision and enforcement, and added a supplemental guidance to the board policies and charters. We also updated the collateral risk management by adding a new collateral evaluation requirements. In June of 2025, we published internally updates to the post-merger guidance regarding how to address the use of our ART tool for mergers. In addition, OE staff continue to participate in external meetings with the system during their events and with their work groups. Next slide, please. In addition to the activities at individual system institutions, as part of our National Oversight Plan, or NOP, Excuse me. There are other significant strategies and initiatives which focus on a broader set of system risk oversight and examination objectives. Listed on this slide are the 6 NOP focus areas for fiscal year 2025. We had 8 related strategies, all of which were completed as planned. Of the 8 strategies, 7 were systemic strategies, which are generally reviewing and evaluating system-wide risk, while the remaining 1 strategy was an institution strategy in which was implemented by EICs at institutions based on their risk assessments. The first focus, I'd like to highlight some of the strategies and accomplishments for each focus area. The first focus area was sustainability and capitalization practices. The examination activities related to this focus area was an HEA that was completed at selected institutions, and we reviewed long-term sustainability of capital plans and practices, and the ability to support the growth through retained earnings. OE issued a memorandum to all system institutions with outlining our findings and highlighting sound practices on June 18th, 2025. The second focus area was innovation through automation and artificial intelligence. In coordination with the other FCA offices, we conducted a system-wide automation and AI survey to ascertain the level of automation and AI adoption in the system. We sent out 64 surveys and initially received 37 back. In September, we reopened the survey and received 17 additional survey responses for a total of 54 surveys completed. We are updating our analysis to include additional surveys, and we will identify any additional insight and perspectives in our updated executive summary. The third focus area was mission-focused lending. Examination activities for this area included evaluating YBS programs through reviews of institution business plans and YBS non-lending reporting. During some examinations, we increased our reviews of eligibility and scope of lending guidance, including criteria and documentation expectations. We also conducted transaction testing and evaluated a sample of loans close to urban population centers for eligibility. The fourth focus was sound governance. We didn't require specific examination activities related to this area, but enhanced our guidance to our examiners for use of our risk-based examination approach in identifying areas central to maintaining strong governance. These would include sound governance and sound control environment, including but not limited to succession planning, board director elections, and standard of conduct. The fifth focus area was credit and collateral risk exposure. We had 3 activities related to this focus area. The first activity was to identify sponsored equity and leveraged lending transactions in the system and examine based on risk. We added these transactions to regularly scheduled loan reviews and continue to monitor results for this risk trends. We summarized and communicated to OE management key findings and issues during reviews of these transactions. The second activity, we worked with ODAE and developed a new Power BI report. Examiners can use this report to identify exposures to borrowers operating in stressed industry segments, or those possessing risk characteristics that could indicate increased credit or collateral risk. The new report and staff training was provided during our April OE training, with more in-depth training provided during our field office staff meetings by our credit specialists. EICs and asset leads can use this report to identify or complete their risk assessments. In addition, starting in August, our credit program manager has held monthly credit chats with OE staff to discuss credit-related issues or tools. The The third activity, we collaborated with ODAE and developed a reporting tool to identify land in transition. Examiners also received training on this tool in April. EICs and asset leads can use this tool to select land in transition loans for eligibility, to be examined for eligibility in loan reviews. The sixth and final focus area was cyber risk management. Examination activity for this area, we completed an evaluation of cyber risk management rule at selected institutions. IT specialist program representatives presented the cyber risk management rule compliance examination findings to the OE executive management team. The system memorandum was issued on November 10th, 2025. Next slide, please. One of our consistent operating plan objectives is to evaluate the system's fulfillment of its GSE public mission in meeting the changing needs of agriculture and rural America. Our ongoing oversight and examination activities regularly address compliance with a variety of mission-related areas. In addition to these ongoing activities, in fiscal year 2025, we focused on compliance with the new YBS rule during statutory compliance examinations and YBS ratings and data. The YBS frequently asked questions are now available for public viewing on the FCA website. For YBS ratings and data, examiners reviewed non-lending reports and other materials provided by institutions and updated qualitative ratings as of June 30, 2025. Our YBS strategies included continuing to collaborate with ORP, ODAE, and OIT on several items, including continuing to work internally with the system to improve usability and consistency of YBS lending and non-lending data. ODAE continues to gather and evaluate YBS data regarding potential quantitative YBS metrics. The work we are doing on improving the data will be helpful once the quantitative rating process is developed. Next slide, please. With regard to OE operational efficiency and effectiveness, OE continues to enhance and expand examination tools and reports available in our EDGE environment. Enhancements include updates to the scoping tool, loan work paper, and OE feedback application. Key enhancements to the scoping tool included additions to assist EICs in planning and managing the exam process, and for supervisors to provide feedback. We were working with OIT to begin the exam guidance modernization project. We also began the Associate Examiner Competency Evaluation System Modernization Project. We added additional EDGE reports to assist all OE staff with the examination process. And we worked with OIT on Microsoft Teams collaboration features, as well as other data analytics and tools in coordination with ODAE. We also continue to modernize OE management reporting and planning processes by transitioning to more automated processes or analysis tools. Examples of this would be continued developing and enhancing the Power BI tools and reports for travel-related costs and OE headcount. We continue to make improvements to the FCS loan database. We are working with the system to improve data reliability and develop new reports. An example of this would include the quarter-to-date charge-off and recovery fields that went live on September 30, 2025. Additionally, we provide data change requests to the system for 2026 to improve data consistency and usability. We worked with ODAE and OIT to maintain FCA's GIS processes. Next slide, please. At this point, I will turn it over to Nicole Peak to provide a human capital and budget update.
Thanks, Jessica. Good morning, Chairman Hall and Board Member Smith. I'll be starting our human capital update by providing information on our hiring and retention for the fiscal year. The Office of Examination did not meet our hiring and retention targets for fiscal year 2025. The deferred resignation program and the hiring freeze impacted our human capital plans. We lost 15 staff members to the deferred resignation program, which I'll refer to as the DRP. Our attrition rate was 12%, which was significantly higher than the 8% we saw in 24 and our planned 9%. Our attrition rate typically fluctuates between 5 to 10% each year. Hiring were 3 less than planned due to the federal hiring freeze. We onboarded 9 associate examiners out of the 14 initially hired. We were also not able to complete all of our mid-career hiring plans. Since fiscal year end, we have hired 2 associate examiners. Our operating plan outlines that we will hire 7 mid-career specialists, of which 5 are IT specialists and 2 would be capital market specialists. We have received approval to proceed with our external job announcements for 5 of the 7 mid-career positions. We posted these announcements for capital markets and IT specialists on November 24th. While not originally included in our operating plan, we were also approved to hire 3 associate interns and 4 associate examiners. We plan to reach out to recruiters and universities once those job announcements are ready so that we can get the word out there. We did complete all of our human capital strategies for training, development, and knowledge transfer. We continued to offer rotational and temporary assignments, developed and conducted advanced training for our commissioned examiners, and provided a wide variety of training, including our OER training, manager meetings, and weekly field office staff meetings. We also held an OE training event in April, which was very well received by staff, and we have started working on our 2027 OE training event, which will focus on training and development. Next slide, please. I'd like to highlight a few of our human capital outcomes for the fiscal year. This slide shows that we were below where we thought we'd be for total staff compared to our optimal goal of 190 due to the impacts of the DRP and the hiring freeze. We have a long-term goal of staff being 190, with commission examiners representing 100 of those spots. This goal is based on the system size, complexity, and constantly changing risk environment. In 2026, we plan to outsource a workforce study to evaluate our composition goals and office structure. With respect to OE staffing levels, the tables on this slide compare planned staff days to actual at fiscal year end, with total OE staff on the left side and commission examiners on the right side. For total OE staff, we began fiscal year 25 with 186 staff on board, 3 less than planned. By fiscal year end, we had 23 attritions and 15 hires, bringing us to 178 staff on board, which is 11 less than planned and 12 less than our optimal goal of 190. The variance between planned and projected is a combination of fewer on board at the beginning of the fiscal year, more attrition and retirements, and fewer hiring than planned. Outside of the DRP, OE experienced 8 attritions, 5 were retirements, and 3 were general attritions. Over half of our 23 attritions were commission examiners and technical specialists. With respect to commissioned examiners, we ended the year with 3 commission examiners lower than planned due to those same factors I mentioned. For our commission staff, we had 10 total attritions. These attritions and retirements were offset by 11 newly commissioned examiners. In this area, we did exceed our goals. We were planning for 10 newly commissioned, and we had 11 newly commissioned in the fiscal year. However, overall, we are significantly below our short-term and long-term goals in the area. As I mentioned before, this is something we're specifically looking at in our workforce study, and we'll evaluate the optimal composition for OE. About 14% of OE staff are retirement eligible in the next 5 years, but more importantly, 10% are eligible for retirement by the end of fiscal year 2026. A significant number of those eligible are senior examiners, technical specialists, and senior managers. Based on expected retirements, general attrition, and hiring restrictions, we estimate we will not meet that 190-person goal until fiscal year 2031. Next slide, please. Turning now to OE budget results. As illustrated on the chart on the left, we use nearly 100% of our $40.6 million budget. The primary reason we were right at budget is because actual expenses were lower than planned and excess funds were released for use elsewhere in the agency. The table on the right shows full-time equivalents were below our budgeted amount due to higher attrition rate than expected. Next slide, please. In summary, here are the highlights of what we accomplished in fiscal year 25. We conducted all of our planned oversight and examination activities. We completed all of our operating plan strategies and objectives, including our national oversight plan strategies. We remained focused on a highly effective OE staff level to accomplish its mission. And finally, we actively managed our budget and were within budget parameters under the continuing resolution. Next slide, please. This concludes our presentation today. I'd be happy to answer any questions from Jessica and I's presentation.
Questions, Board Member Smith?
Not any questions, but just a comment. We had quite a discussion, Nicole, about the HR challenges this past year, which all offices experienced, but it was of particular concern that we made sure our examination and supervision activities continued as planned, and we can see that they certainly were. I know that on the board level, we probably don't see all the shifting and everything that went on behind the scenes, the sharing of responsibilities, taking on of additional responsibilities, but just want you to know that I'm very appreciative of what happened. I think it's remarkable that we ended up the year in delivering our mission in good shape. So I thank you for that.
Very good comment.
Yeah, thank you.
Thank you, Nicole. Jessica, for your presentation. If there are no further questions, I'm going to ask everyone to turn to the adjournment tab. And if there's no further business to bring before the board, I will entertain a motion to adjourn the meeting.
Mr. Chairman, before we do adjourn, I would like to bring attention to the fellow sitting to my left, who's been at the board table for 19 years now. 17. Okay. As head of OCPA for most of those years, my executive assistant the last 3 years, and the head of chief of staff the last 2 months. But I would like to go on record, a very critical part of our senior staff team and what we do here at the agency, and go on record of gratitude for your service to Mike Stokey.
Let me add to that a little bit too. I mean, it's Mike onboarded both of us, you know, and so we've kind of used him as a utility infielder. He's pretty much done several jobs within the agency, and he has done it admirably. Really appreciate everything Mike has done, and especially the last 2 months serving as chief of staff. Job. We really appreciate it, Mike. Thank you
very much. Thank you. I'm going to give him my hand. He's turned a little red, but anyway, with that, I move that we adjourn the meeting.
And I'll second the motion. Motion has been made and seconded. Is there any further discussion? If not, I'll ask Secretary to record the vote on the motion.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carries, and this meeting is adjourned.